Welcome back to the Deep Dive. We are the synthesis machine that takes the fire hose of earnings transcripts, analyst notes, and management commentary and distills it all into crystal clear strategic insights for you. Today, we're on a pretty critical mission. We're diving into the Q2 fiscal year 2026 earnings for Outdoor Holding Company. That's the entity behind the massive GunBroker e-commerce marketplace. Now, for anyone who's been following this story, this call, this was really the moment of truth. The company has spent the last few quarters performing some serious corporate surgery. They divested their high-cost ammunition business to pivot to a pure-play, asset-light e-commerce model. And the stock reaction, up 11% pre-market, gave us the immediate answer. But our mission is to understand why the market reacted so strongly and if this pivot has truly delivered. Okay, let's unpack this.
We absolutely have to, because these results, they weren't just a win. I'd call them a vindication. The biggest story here isn't even the revenue figure. It's the fact that this company officially reported its first quarterly GAAP net income from continuing operations since this whole restructuring began.
And that's it, right? That is the ultimate confirmation. Shed the complexity, and you find the profit that was hiding underneath it all.
Precisely. They reported GAAP net income of $1.4 million. Now, if you look back just 1 year, in the prior period, they had a staggering loss of $5.87 million.
Wow.
That kind of swing, that's nearly a $7.3 million swing into the black. It's monumental, and it just instantly changes the whole narrative. And that reversal translated directly to the bottom line for investors. GAAP earnings per share from continuing operations landed at a solid 1 cent.
1 cent. And the street was expecting a loss.
A big loss. The consensus was predicting anywhere from -3 to -5 cents. So when you see that, you understand the 11% shockwave. They didn't just beat estimates, they proved the model actually works.
So what about the top line? They're operating in a pretty soft, even shrinking industry.
Right, and yet they still managed to beat expectations on revenue. They came in at $11.98 million against an estimate of around $11.23. And, flat revenue year over year in this kind of environment is actually a massive victory.
Yeah, that's a good point.
Think about it. They spent the year actively right-sizing, shedding legacy parts. To maintain their revenue base while doing all that cleanup, it suggests real underlying strength in the core marketplace.
So they're building a healthier business, not just a smaller one. The market obviously loved the surprise profit, but like you said, we need to get past the headline. How did they do it? A reversal like this? It doesn't just happen.
No, it takes a knife. It was absolutely surgical cost cutting, and this is where the deeper financial story really is. The company basically looked at every single non-core element of the business that wasn't GunBroker and just eliminated it.
Full amputation.
Successful one. They cut off the high-cost, low-return operations that had been just draining cash for years. The number that should really stick with you is the reduction in operating expenses. Excluding D&A, OPEX declined by about $6.7 million year over year.
$6.7 million.
Just think about that for a second. That number is the proof that the legacy business was actively destroying value. And that's the source of the profit swing we were just talking about.
Okay, a $6.7 million cut is huge. But where did they find it? Was this all just a one-time thing, or is it a permanent structural shift?
It was both, but it's primarily structural, which is key. The savings are sticky. First, they saw a massive reduction in general legal fees and ongoing litigation. And crucially, they also took a one-time settlement contingency for the ammunition sale, an expense of $1.8 million, which, it's a cost now, but it clears up so much uncertainty for the future.
So they basically paid to get rid of the noise.
Exactly. The second pillar was pure efficiency. They cut compensation-related expenses by over $1 million just by right-sizing the headcount.
Right.
They now have a smaller, more streamlined team running GunBroker, proving that this asset-light model requires way fewer people and less infrastructure. They're just lighter and faster.
And it sounds like that discipline went all the way down to cash management, too.
That's right. They even cleaned up their receivables. Bad debt expense saw a $400,000 reduction, which they said was from more rigorous collection efforts. All of this discipline it let the structural advantages of the pure play model finally shine.
Which brings us to margins.
This is where it gets really good. Gross margins stayed incredibly high, ticked up a bit to 87.1%. But look at the operating leverage. Adjusted EBITDA rose 24% year over year to $4.91 million. Now listen to this next part. That $4.91 million represents 41% of net revenue.
41%. A 41% adjusted EBITDA margin. That is a stunning figure, especially for a company that was posting huge losses just a year ago. Put that in perspective for us.
What's fascinating here is just the immediate realization of that leverage. A 41% adjusted EBITDA margin that puts them firmly in the world of high-performing, asset-light tech platforms.
Not retail.
Not retail at all. Think payment processors, specialized software companies. This margin just proves they've shed all that low-margin baggage. The GunBroker platform itself is just inherently high margin. They don't hold inventory. They don't manage logistics. They're just the meeting place. And it's showing up right there in the EBITDA number.
And that kind of margin must have gone straight to the balance sheet.
It did. The company generated $2.3 million in cash from operations this quarter. They closed the period with a really strong cash balance of $65.7 million.
That's war chest.
A very nice war chest. It gives them the dry powder they need to invest in growth or, eventually return capital to shareholders.
Okay, so the financial structure is clean, it's profitable, it's generating cash.
Yeah.
But none of that matters long term if the core marketplace is sick. Did the operational metrics for GunBroker actually confirm that health?
They tell a story of market share gains. And you have to start with the environment they're in. Adjusted NICS checks, that's the key metric for industry demand, they were down over 5% in the quarter. It's a contracting industry.
Down 5%?
Yeah. But despite that pretty significant headwind, the company's firearm unit sales actually increased by 3%.
That's textbook outperformance.
It is. They're actively gaining market share, increasing their adjusted share of NICS by 50 basis points to 6% for the quarter.
So in a tough market, they're proving they're the stronger platform. How are they maximizing the value from those users?
They're getting better at monetization. Firearm GMV, that's gross merchandise value, it saw modest growth, 1.2%, but the key metric, the take rate, the fee they charge, raised 7 basis points to 6.34%. That rise confirms the platform is successfully rolling out better monetization features, and people are adopting their high-margin seller services.
Right.
Listings and average order values were also up, which is great.
I want to zoom in on something management highlighted, the used firearm market. Used firearm GMV was really strong, up almost 8%. Does that just mean customers are trading down because of the economy?
Management was actually really careful to push back on that trade down idea, and their insight here is fascinating. They don't see the strength in used items as a sign of consumer weakness. They see it as a deep structural advantage of the GunBroker platform.
And why is that distinction so important?
Well, think of new firearms as commodities. Supply is basically infinite, price competition is fierce. Now, think about a used, collectible, or unique firearm. It is intrinsically scarce.
Like a rare antique or a piece of art.
Exactly. Because every used item is unique and supply is limited. If it's priced reasonably, it sells at an almost guaranteed very high rate.
So the platform is capitalizing on scarcity, not just commodity pricing.
Correct. And that leads right into their major strategic focus. Management confirmed they are investing heavily in technology APIs, point-of-sale connectivity to solve the listing complexity for professional dealers. The goal is just to unlock all that used inventory that's too much work for shops to list manually.
Here's where it gets really interesting. They've done the cleanup. They have stability. So what's the forward strategy? It's time to play offense with that 41% margin.
They're definitely shifting gears. The transition to the pure play model is done, and the focus now is all on efficiency and growth, powered by that high margin structure.
So what's in the immediate innovation pipeline for users?
Well, beyond things like upgraded search and better buyer personalization, there are two major growth catalysts. First, the goal of implementing universal payments. That means getting credit card coverage for basically 100% of the merchandise. In this market, just removing payment friction is a huge deal for conversion rates. Second, and this ties right back to our talk on used inventory, they're going all in on using AI. Their main target is simplifying those incredibly complex listing procedures for used items. If they can make it nearly instant for a dealer to list something, the GMV upside is just enormous.
And on guidance, they didn't give specific numbers, which is pretty typical, but the tone was incredibly bullish.
Oh, absolutely. Management kept emphasizing margin expansion, cost discipline, GMV growth. They even stated they believe the old adjusted EBITDA goal of $25 million, which was already ambitious, can be beaten over time.
Which suggests the cost savings aren't done.
Exactly. One manager even used the phrase, "This is the tip of the iceberg."
Tip of the iceberg.
Yeah.
That implies a lot more to come. They also finalized some important structural cleanup too, right?
Yep. They regained full Nasdaq listing compliance, which gets rid of that risk, and they finished consolidating their HQ in Atlanta, further cutting their footprint and overhead. Every decision is about optimizing that core. However, this raises an important question about the lingering noise. While the operations are clean, management did caution that variable legal and indemnification expenses tied to former officers will make the overall results uneven for a while. So you have to prepare for some volatility outside of the core numbers.
So synthesizing this for you, the listener.
Yeah.
The story is a clean break. The pivot worked. This performance proves the asset-light model can gain, share, and monetize better, even in a soft industry.
Yeah.
They've shed the past and unlocked the core.
It's proof that a highly valuable cash-generating business was just being choked by complexity, and now it's free, it's well-funded, and it's structurally ready to go.
Okay, now let's turn to our required segment. This is not financial advice. We are going to pitch an outrageous but plausible trade idea based strictly on the data from this call, as if we were analysts pitching to a demanding investment committee. As we said, the company ended the quarter with $65.7 million in cash. Management explicitly said they're exploring shareholder returns. Given that extraordinary 41% adjusted EBITDA margin we just talked about, the trade here is an aggressive operating leverage and share reduction play. The logic is simple, but it's powerful. The stock is traded at a discount for years because of all that legacy noise. That noise is clearing. The business is now a proven cash machine. It's time to deploy that cash, not just hoard it. So our pitch is this. Management should commit to deploying 20 to 25 million of that cash pile immediately into an aggressive, accelerated share repurchase program.
Right, and let's break down why that creates such explosive potential. When a company buys back its own shares, it just reduces the number of shares out there in the market, what we call the public float.
Think of the company's annual profit as a cake. If you rapidly shrink the number of slices that cake is divided into, everyone's remaining slice, their earnings per share, gets a whole lot bigger.
Exactly. And when you combine the force of rising profits, which we expect from that tip of the iceberg, cost cutting, with a shrinking share count, the resulting EPS acceleration is substantial. I mean, almost violent. This kind of leverage play would instantly force the market to re-rate the stock, to give it that clean, high-margin, pure play valuation and eliminate the legacy discount for good. It's a bold move, but the potential reward on EPS is just exponential.
So what does this all mean?
It means Outdoor Holding Company has completed the turnaround. They're transitioning from a defensive cleanup mode to an offensive innovation mode. That first GAAP profit is a critical line in the sand. It shows the new model is sound.
And here is the final provocative thought for you to chew on. Management is laser-focused on using AI and streamlined tools to simplify listing used items, calling it their major untapped opportunity. If they actually succeed in making that process seamless for the thousands of dealers sitting on vast unlisted inventories, what's the true untapped ceiling for high-margin GMV growth on the GunBroker platform? That is where the exponential opportunity lies. Thank you for joining us for this deep dive into the Outdoor Holding Company earnings call. We look forward to synthesizing the next one for you soon.